Now, there are myriad investment options in the realm of equity mutual fund schemes, each of them serving a unique purpose, and they could all of them potentially find a place in your portfolio depending on your objectives. Now, today I'd like to focus on a category that's meant to give investors exposure to companies across market capitalizations. And this category has changed over the past couple of years on account of regulatory intervention. We're talking about multi-cap funds and flexi-cap funds. Joining me to talk about this in more details is Santosh Navlani, the Chief Operating Officer at ET Money. Thanks so much, Santosh, for taking the time.
Hi, Alex.
Now, this category of mutual fund schemes could confuse investors just a little bit because the erstwhile multi-cap schemes are now the flexi-cap schemes, and the current multi-cap schemes have a different definition from what they initially did. Could you start by telling us what these schemes are all about and why the SEBI felt the need to intervene in their functioning?
Sure. So, Alex, back in October 2017, SEBI had actually done a major rehaul of how the mutual fund schemes were categorized in the country. And they had bring a broad definition of what each kind of category meant for retail investors. So at that point of time, multi-cap categories used to mean that a fund manager will actually be managing money without having any kind of market cap bias and would look towards having a diversified exposure towards different kind of market segments in the market. And over the period of time, things have been moving fine. But what SEBI felt towards 2020, and especially around November 2020, the decision was changed, where they felt that most of the mutual fund schemes in the multi-cap category were actually being managed as a more of a quasi-large cap schemes in that sense, where almost 80 to 90% of the allocations were towards large cap stocks, and only about 10 to 15% was towards non-large cap stocks, and barely any kind of multi-cap scheme in that time, as they used to be called, was having any kind of small cap exposure. And that's why SEBI actually felt that they are not being offered or operated as true to label as SEBI intended to have the categorization, where the fund were supposed to have some kind of exposure to all the market caps for the investor. And because people who invest in multi-cap came with that expectation. So that was kind of made for question, and SEBI felt that it should be done away and there should be some kind of minimum allotment or allocation towards all the market cap segments. And SEBI, with a lot of industry consultations, then introduced a new definition of multi-cap, as it was called, and how the existing scheme were managed. They were allowed to kind of operate as flexi-cap schemes. So the difference is flexi-cap schemes actually are having no kind of market cap bias, as long as the fund manager believes that a specific stock actually has a role to play in the portfolio. He or she would not bother about whether it is large cap, mid cap, or multi-cap or small cap. They would actually buy the stock and manage the portfolio. It may be run as a primarily large cap scheme, primarily mid cap, or a mix of all. It doesn't matter. And the multi-cap rule is modified, where SEBI said as long as at least 25% allocation is done in each of the market cap segments, large cap, mid cap, small cap, it could be called as a multi-cap scheme. So there was a primary difference which was brought in, and things were made clear. Though the people in the industry or the customers, the end investors, are yet to really understand the entire thing. We will talk more about it as we move along the show.
In fact, I was going to come to the next point. Before we get into some of the cons, I would think, with multi-caps, let's talk about what objective they're meant to serve, Santosh, in somebody's portfolio. At least theoretically, the erstwhile multi-cap fund was supposed to give you some access or some exposure to what would be potential multi-baggers over a period of time, right? Because you would assume that a certain stock is making its way. It's relatively small in terms of market capitalization, but the potential is humongous. At the same time, you're protecting your downside by having a significant exposure to established companies. But that wasn't really coming through. Do you think that somebody looking for that exposure should now go to multi-caps? How should they operate in the context of somebody's portfolio?
So I think Alex, investors always have their own objectives. So uh, it, both the categories play very very different roles. Uh, uh, I would like to kind of cover each of them slightly more in detail. See, what does investors should actually be doing with their money? If they are trusting a mutual fund manager, a fund manager to manage their money better than themselves, then ideally they would not really want to control that. Hey, fund manager only allocate so much percentage to a certain kind of market cap or a sector or a things like that. They would let the fund manager run the way he or she believes the fund should be run. And I would bias towards a Flexicap scheme in that case, where a fund manager, if he or she believes that they need to allocate more than 15 to 20% to small cap, they would do that. If they want to relocate a kind of a one third of the portfolio to mid cap because the market is making them feel that way, or the read of their future earnings and things like that are making them take the decision, let the fund manager take that decision. So let the fund manager run a proper diversified portfolio for you without having any kind of set milestones in your head that I should at least be having so much allocation. If you are clear that you need to have at least 25% allocation to small cap because you are an aggressive investor, you really want to invest for next 5 10 15 20 years, and because you believe in the growth story of the country and the small businesses will become large cap over a period of time, then of course it makes sense to allocate a large portion to small caps. And you can say that let me have a multi-cap fund in its current form and shape and size, where 25% will go towards small cap, 25% minimum will go towards mid cap, and rest can be fund manager's choice. So I think if you look at both these things, they actually can do both the jobs. Both the funds can do the same jobs, just that one is being forced to always operate with the constraint that 25% in mid cap and small cap each makes 50% portfolio towards emerging companies, which may not be always the best thing for investor if he or she is not prepared for the ups and downs in the market.
Absolutely. In fact, that was going to be my next point, or the next question that I would ask. In the current context, Santosh, where you're seeing on a daily basis some of these smaller names getting drubbed, getting beaten down because maybe their valuations had gained tremendously over the past couple of years. This is a scenario which is not really very favorable for a multi-cap scheme, because you would still have to continue to have that kind of exposure or allocation towards mid-cap and small caps. So that's a big negative, isn't it?
Of course, I have a personal bias towards Flexicap and going against multicap in that sense. But what you're saying is perfect, Alex, in today's market. And I know if you look at data as well, if you look at the rolling returns of 3, 5, 7, and 10-year periods for large cap, mid cap, and small cap as different segments of market, you would notice that the small caps do tend to give you an extra alpha over mid and large cap stocks. But what they also bring along with them is a lot of volatility in the returns. So the extra 1% return that you might earn over long periods of time in small cap, and 1% over a long period of time is not a small amount. It's a large, healthy an alpha for the portfolio. But they also bring in about 2% volatility extra, like extra ups and downs. So, and when you look at today's market, where Ukraine situation is kind of creating all this havoc in the markets, a lot of earnings visibility is going to be in question for some time. And maybe inflation is there, maybe interest will go up. All these factors are going to have a large bearing on mid and small cap stocks specifically than a large cap stock. So in that environment, sticking to your guns that I want to have at least 25% exposure to mid and small cap each may give you a lot of volatility. But there's nothing saying that it's a bad choice, just that you have to be more patient and say that I'm going to invest in this kind of strategy for at least 7 to 10 years and let the fund manager create the alpha over long periods of time for myself.
Actually going to ask you about the time horizon, because one would think in any case, Santosh, if you're investing in equity, you would need to give it a decent runway, a decent time horizon. But you would look at these two scheme categories a little differently in terms of how much time you give it, right? So how do you need to bring that into your planning?
So there is no kind of a hard and fast way, Alex, on this, because multicap in this new form and shape and size has been introduced only November 2020. So we don't have enough data how the strategy will operate when minimum 25% allocation is being given to mid and small cap each. How does portfolio would perform? But statistically speaking, you would always have slightly lesser time horizon towards your ideal horizon of equities when you invest only in large cap, slightly more when you invest in small mid cap, slightly higher than mid cap when you invest in small cap. So if I were to put theoretical numbers there, I would say minimum 4 to 5 year horizon should be there for one's allocations when one is putting in large and mid cap kind of strategy, and at least 5 to 7 year horizon when you small cap kind of strategy. So by definition, when 25% of your money is always going to be in small caps, you need to have like good 5 to 7 year horizon minimum for a multi-cap investment, if not higher, versus Flexicap, which basically would be run as a pure diversified scheme without any kind of market cap bias. And they would typically be having like good 60 to 80% allocation to large cap, and of course, rest of the balance for generation of alpha in the portfolio by allocating mid and small cap. So maybe 5 year horizon for a flexi cap and maybe 6 to 7 year horizon for multi cap is how I'd put it. But that is not something which is like an ideal scenario or a hardcore number that you should go with. One advantage of flexi cap is flexi cap also offers some of the funds in the category also offer you an international exposure, because as per SEBI definition, a flexi cap can have at least 65% in equity allocation, and rest of the money can be in debt, cash, or even international equities in that sense. So
Right.
some of the fund houses actually offer you a very good one solution that you actually buy one fund and buying the entire world, because you're buying India and you're buying some kind of developed markets as well in the same fund.
I'm glad you pointed that out, Santosh, because I wanted to also talk about how you choose. And you've established quite clearly that FlexiCap is perhaps the way to go when you're talking about the two alternatives. And if somebody has a much higher risk threshold, they can look, and time horizon, of course, they can look at multi-caps as an option. But if we're talking about FlexiCap specifically, coming down to the nitty-gritties of it, you mentioned that there are mutual fund schemes that offer international exposure as well. Of course, they are limited to a certain extent right now because of the limits. But how do you go about choosing the right strategy for you? Because each fund house has a different interpretation of FlexiCap, a different way in which they operate. So how do you go into the details and find out what's right for you?
So again, since we always speak on as ET money that we are not really somebody who is predicting the future better fund in the marketplace. So it's very tough to say that which fund one should go for. But given the market structure today, there are many flexi cap funds which actually have done really good performance without having international exposure. And there have been fund houses where they have taken the help of international exposure to create alpha. So there is a scheme, mutual fund scheme in the name of Parag Parikh Flexicap Fund, which actually used to be called long-term equity fund in the multi-cap times. So this scheme actually has about 35% exposure towards international equities. They have whole stocks like Amazon, Microsoft, and things like that. So wherein you basically know that you are buying always 65% is India allocation and rest being international. So it's a great choice as long as Parag Parikh continues to outperform the benchmark as they have been. Otherwise, if one is looking for a pure passive flexi cap way of investing, a Nifty 500 fund there's a Nifty large and mid cap index fund by Edelweiss and Nifty 500 by Motilal Oswal. They are very healthy choices because you are just buying the market blindly in that sense. You're not really bothered about picking up a fund manager or a mutual fund house or a scheme one over the other. So that can be a healthy choice. A good large and mid cap index fund or a good Nifty 500 index fund can do the job. Or you can avail an advisor service. Like in ET Money, we have this offering called ET Money Genius, where we actually offer you a bouquet of kind of passive funds and create a multi-cap / flexi-cap exposure depending on the market scenario. So the portfolio may operate as a multi-cap strategy when the markets are conducive to that kind of approach, and it may operate as a flexi cap fund when the markets are conducive to that kind of approach. So I think if you can mix and match based on the market scenario, you may take different choices depending on the time horizon and the risk profile of your own as well.
Option of passive is interesting there, considering the kind of weightage that the large caps have, right? Because effectively you are, when you say you're buying the market, you're buying a large portion of the large caps because of the kind of weightage that they have. But it's been an insightful conversation. Santosh, thank you so much for joining in and for taking the time.
Thanks, Alex.
All right, now we are slipping into a short break, but on the other side, we talk about the latest offering by the NSE IFSC, which allows you to buy depository receipts of US listed stocks. Do stay tuned and we'll tell you all about it.